If I set the stage for you, if you're new to the infinite banking concept, the ultimate problem that it is solving is your ability to control capital. Okay. And if when you're first exposed to the infinite banking concept, it might appear to be like, oh, there's some kind of magic in doing loans, borrowing against a life policy. That's not the case. There's no magic in loans. Simply, this is a formal, on purpose, with intent, capital formation. And when you have access to capital that you own and control, then you can control the banking function. You can control the banking function, and that's can be very profitable for you, okay? But ultimately, this is a capital formation, and it's a long-term capital strategy. It's a lifelong capital strategy that has the potential to change your life. When one hears about banking with life insurance, they often hear about whole life insurance and universal life insurance, or IUL, okay? And the fundamental difference is in the construct. With a whole life policy issued by a mutual company, that means a policy owner has an ownership position in the company, so they benefit from the financial experience of the life insurance company through a dividend. And that's the only non-guarantee component of a whole life insurance policy is the dividend. And then you compare that to an indexed universal life policy. It's nothing more than a side fund that earns interest in the internal annually increasing cost of insurance. All right. Today, indexed universal life, they use indices, outside indices, to determine what interest is paid each year on that policy. So it has nothing to do with the profitability of the life insurance company. It has to do with outside markets that you can't control and they can't control. They have to go buy options in that, and those options cost money. There's a fundamental difference in the two. They're not even comparable when you take a deeper look, which I encourage you to do. And Nelson talks about universal life on page 39 of his book, Becoming Your Own Banker, which is a genesis of all of this idea, thought of practicing the banking function with life insurance. So get to it. Whole life insurance is typically used when you practice the infinite banking concept because it has all of the characteristics that are required to perform the banking function. It's a contract. It's a private entity. It has guarantees in there. Ironclad guarantees. And then the non-guaranteed element is directly tied to the profitability of the life insurance company who issued the policy. And they've done very well over the last 150 years. You should learn about it. To understand indexed universal life, you got to fundamentally understand the components that make up the product. And it is nothing more than two components. Number one, annually renewing term insurance that goes up every year that you have a birthday. And then a side fund that uses outside indices. And some are real and some are not. Some are created when they design the policy. The outside index determines how much interest is credited to the policy after expenses are deducted. Okay, so think about that. I pay a premium, all the expenses come out, the remainder is applied to an index that has rates, caps, spreads, bonuses, multipliers, all kinds of little trinkets on there to produce an illustration that'll make you say yes. But when you get down to the fundamental components of an indexed universal life policy, there's an increasing cost of insurance, all the policy fees, all the fees associated with it. The remainder is applied to an outside index. Index goes up, you get a part of that increase credited to your policy, right? And it's nothing but interest. You're not participating in the market. You're not, I'll just leave it at that. You're not participating in the market. And then you often hear zero. You can't lose money in a universal life policy. That is hogwash. You might not be able to lose money due to market downturns, right? But if there's a market downturn and you get credit to zero, there's no interest credited. Next year, your expenses go up. All right. They will absolutely cannibalize themselves over a lifetime. Normally the promoters of indexed universal life insurance, they really want to promote the market-like returns, market type returns, these high rates of return. You're not in the market. It's not a securities. They're using an outside measurement, the life insurance company, in the form of an index to determine how much interest they pay you on an annual basis. All right. And then you hear you can't lose money. Not true. You might not be able to lose money because you're not in the market. When the market goes down, you just get credited zero interest. All right. So there's no market loss, but the internal cost of a universal life policy goes up every year. And they're marketed so you will be enticed by a higher rate of return. Right, that's how they're marketed. And then their illustrations are beautiful. And normally what you see, I see a lot of what you see online. I don't see everything, of course. You'll get one page out of an illustration or a policy statement. The illustrations are over 100 pages. 75, 80, 128 pages. The statements are 90 pages. Wonder why it would take 90 pages to do an illustration, to present an illustration of a life insurance product. Man, that should be your first red flag. Yeah, on an indexed universal life policy, the interest is credited annually, and it's credited from the result of an outside index. If I have $10,000 in account value and it's applied to an outside index, the index goes up 10%, 20%, and they're marketed. No caps and bonuses and multipliers and all of these things, right, that have a lot of ifs in there. But say there's 10,000 there, the market goes up 20, and there's a 12% cap. I'd get credited about 12%, right? But that money that is applied to the index, and it could be multiple index, which are called indices, right? Could be applied to multiple indices, right? That's after the fees have come out. You pay a premium minus all the fees, the remainder gets credited or applied to an index. Right. And then, the company retains the right to increase or decrease the caps, increase or decrease the participation rates, right? Increase or decrease the multipliers or the bonuses or the enhancements. Yeah, they're in complete control, not you. Compared to a whole life policy, I'm paying a premium. There's guarantees all throughout that thing. As long as I pay a premium, the guarantees are going to be met. And then the only non-guaranteed element in a whole life insurance policy that pays dividends is a dividend. It's not guaranteed. It's the owner's financial experience of the life insurance company. And if you think about that, it makes sense. A life insurance company, even though they've been in business 150 years, they can't tell you if they're going to be profitable next year. And if they could, they couldn't tell you how profitable they'll be next year. Just like your company, there are no guarantees, right? But 150-year track record, okay. I'm good with that. I still get the fundamental guarantees of the life insurance. The dividend is the only non-guaranteed element. There's no comparison between whole life and universal life. As a matter of fact, the universal life should be compared to an investment. Although it's not an investment, if you're trying to get market-like returns, go to the market. The major structural, the major differences of whole life insurance and universal life, indexed universal life insurance is the structure. The very components that make the policy up, the very components that are used to create the policy. In universal life, you have two fundamental components: a side fund that earns interest, and then the internal cost of the insurance, the death benefit, that goes up every year. There's all kinds of manipulations that the agent, the professional can do and does to make that illustration very enticing. Right? And they'll send you that illustration that's probably got 100 pages to it, and you're not going to read them all, and neither did they. Right? Compared to whole life insurance, the illustration might be 25 or 30 pages. There's two fundamental components. Actually, three. If you're going to practice the infinite banking concept, you have the base whole life policy, then you have a rider that's a paid up additions rider, and then you may have a term component, whether it's blended with the PUA or it's a separate standalone term. Three different components, two totally different constructs. They do have similarities, but not many. The control that life insurance gives you to practice the infinite banking concept is fundamentally different between whole life insurance and universal life insurance. Okay, number one, it's life insurance. Comes with a death benefit. Life insurance does not come any other way. They are designed to pay a premium over a long time period. With whole life insurance, it only goes one way on a guaranteed basis fundamentally. Then there's a non-guaranteed component, the dividend, that is directly based on the company, the issuing company's financial experience. These companies have been in business for over 150 years. They're likely going to be profitable next year because they were for the last 149 years. It's not a, you don't even think about that twice. Now, they may be more profitable next year than they were last year and so forth. You compare that to a universal life policy and you have a target premium that's similar to the base premium of a whole life. It buys a death benefit. It has an account value. That account value is going to go up. All right. It's designed to go up. And then you have a side account with the Index Universal Life. And this side account are indices, different indices, S&P 500. They create them on an annual basis, new ones that never existed, so they can make that illustration look really good. Okay. And I don't want to sound harsh. Universal Life is what it is. But when it comes to banking, you want long-term increasing capital that you have control of. You do not have that guarantee with Universal Life. It just doesn't exist. As a matter of fact, the life insurance company has transferred the risk back to the owner when it comes to Universal Life. Now, if you think that through, okay, I buy insurance to transfer a risk, whether it's fire insurance, car insurance, health insurance, whatever it is. I'm paying a premium to transfer the risk of loss away from me to the insurance company. When I do that with Universal Life, they transfer the risk right back to me because the guarantees, there's no guarantee that it's going to be enforced when I die. And there's a 100% chance you're going to die. Me too. The guarantees, comparing guarantees between whole life insurance and universal life insurance. Number one, whole life insurance, I have a base whole life policy. All right. The cash value must equal the death benefit at age 120 in most of today's products. Okay. Guaranteed basis. We can all look in hindsight and, go forward 5 years and calculate internal rate of return. There's more on this channel about that. And then you have the PUA premium, the paid up additions. Same thing. All right. That cash value in the PUA must meet the face amount at age 100. Those are the fundamental guarantees of a life insurance policy, the whole life insurance policy. The non-guaranteed component is the dividend that's paid by the life insurance company each year. It's not guaranteed because it's based on their profitability. When they're profitable, they pay a dividend. Well, they've been profitable for over 150 years or they've gone out of business. Okay. So the ones that remain today are, pretty strong. They're going to pay a dividend, but it's not guaranteed. Compared to the guarantees of the universal life policy, you have a guarantee that the cost of the death benefit is going to increase every year that you have a birthday, every year. The guarantee that if the money that is applied to an outside index, the guarantee is a zero rate of return, right? So if the index goes down, you don't lose money. That's the zero rate of return. Then the guarantees are held at the life insurance company, the universal life insurance company, the company that issued the universal life insurance policy. They retain the right to raise or lower the caps, the spreads, the participation rates, and which directly affects what interest is credited to that account. It has nothing to do with their profitability. Nothing. All right, so the guarantees are vastly different and fundamentally different. Let's talk about some of the shortcomings of universal life. Number one, it's not their illustrations because they illustrate very well, especially when the professional knows how to manipulate the illustration. It's seeing what goes on behind the illustration that matters. Frederick Bastiat, that which is seen, that which is unseen. Look, these universal life policies have anywhere from a 7 14, 16-year surrender charge. Now, I get it's a long-term concept, banking, so, okay, that may have its place. Well, you look at what's going on internally, functionally, the cost of insurance rises every single year. Every year. And so ultimately, when you're young, the cost of insurance is pennies. When you're in your mid-50s, the cost of insurance starts going up gradually on an annual basis. When you hit your 60s and 70s, that cost of insurance is vertical. And so you're either paying a higher premium or you're paying a higher premium and cannibalizing the policy account values. It's a matter of time. You live long enough, you're not going to wind up with passive income in retirement, quote unquote, and a death benefit. Just not likely. Why? Because of the cost of the insurance, primarily. You know, when you're exposed to the infinite banking concept and life insurance, you often hear whole life and universal life, and people cannot wait to get an illustration in front of you and point out how much better the universal life illustration is compared to the whole life illustration. You ever wonder why the universal life illustration illustrates so beautifully? Yeah, me too. Okay. And here, let me give you an idea. The illustration number one has been manipulated, more than likely, squeezing the target premium down, which would be akin to the base whole life policy when we're talking about, whole life insurance. Okay. And then the multipliers, the enhancers, the caps, the spreads, the participation rates, and all of this should mean something to you. You should be aware of them if you're looking at universal life insurance, right? The National Association of Insurance Commissioners have addressed this years ago, 2015, 2016, and said, hey, life insurance companies, you can't illustrate more than 6% rate of return on that universal life policy. Well, then the life insurance companies came up with enhancers, multipliers, increasing their spreads and their caps, right? Bonuses, all kinds of little nice adjustments, right? To be able to illustrate those high rates of return that they are not going to enjoy over a long period of time. Can an illustration or can a policy actually receive 20% rate of return in a given year? Yes, absolutely it can. Can they receive a zero rate of return for multiple years? Yeah, 2 or 3 or 4 years over a 10-year time period is possible, right? The whole time, the internal cost of the insurance is increasing every year. Every year. If you're looking for high rates of return, don't commingle life insurance with investments. Go buy an investment with an investment advisor who's properly, educated and licensed, and then go buy life insurance from a professional who's properly licensed and educated and maybe has a little experience. The results for you will, in my humble opinion, be much better. Yeah, let's consider the rising cost of the insurance with IUL policies, the internal cost of the death benefit, cost of insurance. The younger I am, the longer I'm going to live statistically. So the cost of the death benefit, the insurance is much lower because I'm going to pay a premium over a long period of time. Well, the older I get, the closer I get to mortality, the cost of that insurance goes through the roof. It goes vertical when you're in your 60s and 70s. Just look at an exponential curve. All right, on anything. I guess to be this way. Look at an exponential curve on anything. Anytime you have money, a rate of return in time, it has an exponential curve. The cost of the insurance with universal life goes vertical in your 60s and 70s. It'll go so high, it's either going to cannibalize the policy or you're not going to pay the premium or both. The universal life policy illustrations depend very heavily on assumptions that are likely not going to occur, right? The index interest that's credited each year, all of these different indices, you're put in a position to be a stockbroker almost, at least a market timer. There'll be so many that you'll just spread the money across the different indices because you want to diversify. You don't know which one's going to do what. Well, neither do they. If you think about this, when it comes to the interest rate or the interest crediting methods, the interest crediting methodologies of universal life, the National Association of Insurance Commissioners I think 2016 limited what the life insurance companies could illustrate as an interest crediting on an annual basis. I think it was around 6%. There have been 2 adjustments since because the life insurance companies say, oh, we can only illustrate 6%. Well, let's add in some multipliers. Let's add in some bonuses. Let's add in some other things that maybe you have to pay for. Maybe you don't have to pay for enhancers. Maybe the cost of these enhancements are higher as you get older. Maybe they're not. Very broad in what's available in the marketplace. All of those machinations were designed to get around the 6% limitation on the illustrated interest crediting. Now, that's got to raise your eyebrow. It should. Okay, I'm good. The creator of the infinite banking concept, R. Nelson Nash, encouraged the consideration of using only dividend-paying whole life insurance issued by a mutual company. Why? Life insurance is a contract. A mutual company, the policy owner is an ownership position in the life insurance company. So there are 2 components to a policy. Number 1, if I'm going to accumulate capital, I want to do it consistently, on purpose, with intent, with regularity, i.e. pay a premium. All right. And then there is a guaranteed growth. The cash value must equal the death benefit at either age 100 or 120. So if I buy a $500,000 death benefit policy as a base whole life, when I reach age 100 or 120, depending on the product, I'm going to have $500,000 in cash. It's guaranteed. Now, the non-guaranteed component is the dividend. Because I'm an owner of the mutual company, I'm going to share in their financial experience. So the dividend's paid annually, goes right to the cash value if it's designed properly, and then it increases the death benefit. It goes dollar for cash value. It only goes one way. The cash value and the death benefit. Einbahnstrasse. So that gives me certainty. I know I'm going to need cash today. I know I'm going to need capital tomorrow, right? So I want some certainty. And now I want access to that capital because it's a life insurance contract, has a loan provision, gives me, the owner, the contractual right to collateralize that policy. So I have control of the loan and the loan repayment and the premium. Oh, it's a beautiful thing. Oh my gosh, stability versus returns. Now let me think about it. We're talking about my money. We're talking about your money. We're talking about our capital. Do I want to chase returns and experience all that roller coaster? Maybe, maybe not. Could do really good, could not, It's like uncertainty. Maybe a portion of your money should go there. There's no question. But if I'm going to practice the infinite banking concept, I want ironclad guarantees and predictability. Right? I don't need to chase a rate of return. I need to build capital. If I have access to that capital, then through leverage, collateralization, then I can go chase a rate of return if that's what I want to do. And maybe that rate of return is in my household budgeting expenses, cars, education, dental, medical, vacations, whatever. Maybe it's in my business, right? Something that I really know something about, which you should know something about your household expenses in your business, right? Maybe that's a greatest rate of return that you have. When it comes to the infinite banking concept, whole life insurance issued by a mutual company that pays dividends, a mutual company is owned by the policyholders. All right, their policyholders receive the financial experience of the company through the dividends. These companies are 100, 150 years old. They're profitable. They've been profitable. They're going to pay the dividend. That's my experience. The dividend is my share of the financial experience of the life insurance company. And they become huge over time. The dividends become huge. There's an exponential curve in the dividend, right? The dividends become very large over time. Well, you look at the exponential curves of a universal life policy, right? They're issued by stock companies. Just because you're a policyholder doesn't mean you own the company. You're just a customer to the life insurance company. And there's an exponential curve in that policy. And it's a cost of insurance, and that cost of insurance becomes huge over time. 2 different curves, but they look pretty similar. You should be on the other side. If I'm going to practice the infinite banking concept and I want to control as much of the banking function as it relates to me as I can, I'm going to own a lot of dividend-paying whole life insurance policies, right? Because of the guarantees, because of the very nature of the product and the way it's constructed. It's constructed to go up between now and my graduation, my death, all right, in cash value and death benefit. Only one way. If you compare that to universal life policies, the guarantees are just not comparable. It's designed to go up one way, but there's a lot of factors that prevents that from happening. I just need the proper design. I need the proper product. Yeah, banking is not a product. I get it, but we're using dividend-paying whole life insurance. As the creator of the concept, R. Nelson Nash encouraged us to consider the characteristics of dividend-paying whole life insurance. And when we understand those, at least at a very fundamental basis, and we understand the mechanics and the structure of universal life on a very fundamental basis, there's no choice. If you've heard, look, there's some great marketers out in the big wide world, and they really thick throughout the life insurance industry. If you've heard universal life is the best product or the best version of life insurance to use when it comes to the infinite banking concept, you should discover what the creator of the infinite banking concept has to say about whole life insurance and about universal life insurance. You want ironclad guarantees with reasonable historical non-guarantees. It's dividend-paying whole life insurance might be what you're looking for. If you're comparing dividend-paying whole life insurance to universal life insurance, it's indexed universal life insurance, some questions that you might want to know the answer to is, how is the interest credited on the universal life policy? What kind of control does the company have on the caps, the spreads, the participation rates, on the indices, right? And then on the whole life side, what historically have they done with dividends? What is their philosophy? And philosophy matters. I don't care what these huckster marketers say. Philosophy matters. Do you want to put your money with somebody who has a conservative, long-range outlook, right? They're conservative financially. They plan on being around for another 100 years to meet the obligations, which that's all life insurance is an obligation to the life insurance company. So some questions that you would want the answer to is, how exactly is that interest credited? And not at the cursory marketing fundamental level. Okay, you want to understand how these indices work, how the bonuses work, how the multipliers work, how the caps work, the spreads work, the participation rates work, and you want an idea of the internal cost of insurance, right? Those you would want to have some answers to. With whole life, you absolutely want to know the philosophy of the company, the financial standing and position of the company, and their history. And the history of both the stock company and the mutual company. Those are some answers that you would want. I think some fundamental misunderstandings that people have when it comes to universal life, indexed universal life, IUL, and whole life, dividend-paying whole life issued by a mutual company. The fundamental misunderstandings that we have initially, and that are preyed upon by the industry, I might add, is really that the focus being on a rate of return. I can get a rate of return that's much greater in an IUL policy compared to a whole life policy. Well, it illustrates that way, but actually turned out that way is maybe not, probably not. That mainly, the focus on a rate of return. Okay. And then the other misunderstanding is that, you're in the market, you're going to get market-like returns with UL. And you look at whole life and, I can get a higher rate of interest somewhere else. So it really focuses on the interest rates, the biggest misunderstanding, or a very common misunderstanding. And then there's almost no understanding of the construct of the policies and why that matters, right? So don't be a victim of somebody else's misunderstanding when it comes to your decision making, if you're going to put your hand to the plow and participate in this wonderful idea that you can become your own banker and control the banking function. So some of the benefits that you can enjoy practicing the infinite banking concept, and there are many, all right, but it acts like a noise canceling headset. Whenever I understand what I'm doing and I decide to practice this concept, and I go through, underwriting, and I get a life insurance policy on my life or others, and I own it, I have a clear path. There's a premium that's required. I have a clear understanding of the cash value that I can collateralize. And I have a pretty dang good idea of the death benefit that's going to be paid to the people that I love whenever I graduate, right? So it allows me, it intensifies my focus, right? And therefore develops discipline. And then my understanding continues to increase as I use this concept to control the banking function. So it filters out a lot of noise. It heightens my intense, really, purpose and direction and discipline. And I get the benefits of that. And so does my family. So there are a lot of benefits to this concept, but fundamentally it's really controlling the banking function, right? Being able to throw the banker out of your office, not being beholden to the third party lender. Them telling you what you can and what you cannot do, and then swapping assets whenever you are unable to perform, right? You can avoid all of that. You can avoid all of that. Now, if you're a business owner, you think about that. All right? If you're running a successful home, you think about that. Look at all the third-party credit lines, credit cards, whatever, mortgages, whatever that you have. Look at all of that. Who's really controlling that? They're controlling you, and you know it. You can avoid that. And you can profit from that if you practice the infinite banking concept. All right.